The day has finally come. Kiko News is in Spokane, Washington for the Great Silver Debate featuring CPM's Jeffrey Christian and GATA's Bill Murphy. They'll be duking it out over the topic of precious metals market manipulation, fact or fiction. It's moderated by BNN's Andrew Bell, and it's set to begin right now.
Okay, I think we'll start because time is tight. I know we could go on for 2 hours with this event. I'm really looking forward to it. I don't know whether I should have worn a helmet, because I know these guys can really go at it. But welcome to our debate on a very important issue. Is the precious metal price rigged? We're talking about gold and silver. I don't think we're going to get into platinum. My name is Andrew Bell. Some of you know me because there's fellow Canadians here. I'm the host of a show called Commodities on Business News Network. You can check us out at bnn.ca. We're Canada CNBC. We're the only financial channel a mainstream financial channel in Canada. And I'm very honored to be here. I'm having a great time. I've met loads of wonderful people, some friends I've met before. So we're going to just launch right into it. The motion, as I said, is are precious metals prices rigged? We're going to go sort of like a formal Oxford Union debate, minus the annoying English accents. And thanks. No, I have nothing against the English. They're paradoxical people, brilliant, and then just anyway. They're wonderful people, though. So, of course, you know our two distinguished speakers, and they've been adversaries on the two sides of this debate for quite a while now. To my right, Bill Murphy of the Gold Antitrust Action Committee, who's been on a tireless crusade to amass evidence and to argue that central banks and governments have been suppressing the price of precious metals for many years now. And on my left, Jeffrey Christian of CPM Group. And Jeffrey is a skeptic and doesn't believe there's been a campaign of any sort to suppress precious metals. Now, the format basically is I'm going to ask each debater to present his case in 4 minutes. I know 4 minutes is not very long. And then we're going to, after that, when they've each done their 4 minutes, I'm going to fire a question at Bill. They'll each have 3 minutes to provide an answer. First Bill, then Jeffrey. And then we were going to kind of play it by ear, see if somebody from the floor has a question, and we'll just work it from there. I have some other questions if nobody, but I think this crowd is going to have 1 or 2 things to ask. So Bill, could I please ask you to approve the motion, to support the motion that precious metal prices have been manipulated?
Well, I do, Andrew, and before we get started, in the spirit of a friendly, good debate, I have a gift for you and for Jeff. And since we're in different camps, it says, I live on planet GATA. What planet do you live on? So this is for Jeff. I have to. Anyway, here's my spiel. The Gold Antitrust Action Committee was formed in January of 1999 to expose the manipulation of the gold market. At the time, we thought it was just bullion banks. As time went by, we realized it involved the Fed, Treasury, the Bank of England, and so on. It all began when I noticed bullion banks such as Goldman Sachs, J.P. Morgan, Chase Bank, and Deutsche Bank stopping gold from rising above 300 and coordinated selling after LTCM blew up in September of 1998. We had heard earlier they were short up to 400 tons of gold, and all their financial market positions had to be covered. Should their gold position have been covered, it could have buried the short position of various bullion banks and easily caused a panic. In his own bullion blanking explained essay, my debater Jeff Christian stated LTCM had a leverage factor of 100 at the time of the collapse, which helps support how GATA got started in the first place. GATA made a big deal of it at the time, claiming it was a violation of antitrust laws, and it's how we gained early traction. How ironic that LTCM senior counsel Jim Rickards spoke at GATA's Gold Rush 2011 conference this past August. Do you think he would have done so if GATA was so wrong in our analysis back then? For 13 years, we've accumulated evidence of the gold-silver price suppression scheme, which has become blatant almost beyond comprehension. Much of that evidence gathered in the public domain, including historical documents from Fed minutes, which make no bones about our government's wishes to manage the gold price. GATA sued the Fed in an FOIA action to force them to release more documents around their gold swap operations. In the end, we received this court-ordered check of $2,870 from the Fed for illegally withholding information from us. Here's the check from the Federal Reserve to little old GATA. Just recently, a WikiLeaks document for 2009 revealed a cable from the U.S. Beijing embassies to our State Department that the Chinese government believes the U.S. is suppressing the gold price in order to support the dollar. That is a fact. Not for nothing, in this 2009 Counterpunch article, former Assistant Secretary of the Treasury Paul Greg Roberts stated, "How long can the U.S. government protect the dollar's value by leasing its gold to bullion dealers who sell it, thereby holding down the price?" Yet this is the Silver Summit, and GATA's biggest slam dunk home run came via former Goldman Sachs employee Andrew Maguire, who exposed the manipulation of the silver market with his expose of J.P. Morgan to the CFTC in March 2010. At this CFTC position hearing on March 25, 2010, GATA was able to bring the attention of the investment world the emails Andrew had sent to the CFTC about what J.P. Morgan was going to do, and then they did it, specifically on February 3rd and February 5th of last year. 5 action lawsuits against J.P. Morgan for silver market manipulation is just one result of this closure so far. Now, for Jeff, who doesn't think Andrew Maguire exists, here's a picture of him at our conference. We had there were 400 people, 38 countries, and this is Andrew Maguire. These are the emails he sent to the CFTC ahead of time of what was going to happen. At the time, also during the CFTC hearing, I remarked that J.P. Morgan was out 30,000 contracts. The day after Andrew testified and explained what was going on, he and Mrs. Maguire were a victim of a hit-and-run accident, and she is still having complications from that issue the next day. At that conference we had in August, Andrew Maguire got the fastest standing ovation I've ever seen in my entire life. But why? And so I just can't believe that somebody would question the guy's existence. But why should we be surprised? Whistleblower Harry Markopolos spent 10 years explaining to the SEC about Bernie Madoff and his Ponzi scheme, and he was ignored. Look at the damage done for that ignorance. The damage done down the road for ignoring GATA and Andrew Maguire will be far worse.
Thanks very much, Bill. With 12 seconds to go. Excellent. Jeffrey, would you please refute?
I don't think I can even speak that long. But let me see what I can do. First off, GATA has been around for 10, 11, 12 years now. It has said that it's amassed a set of evidence. It actually came at me 2 years ago. It didn't really come at me. It said to its clients or subscribers it was going to come at me. It actually didn't actually challenge me to a debate. But it gave us 6 things and challenged us to refute them. We refuted them. We showed how in each of those 6 things, GATA had distorted the historic record and twisted what people had actually said. You can go to our website, cpmgroup.com, and you can download a PowerPoint presentation in which we go through each of those 6 allegations and show you what the people actually said. In all of this time, GATA actually has not come up with a credible shred of evidence. That's one thing. Second thing is, as is part of the course for Bill and GATA, he cannot get facts straight. I never questioned the existence of Andrew Maguire. What I questioned was whether or not he ever worked in the gold bullion market. I've been in the gold bullion market for 30 years plus. I worked at Goldman Sachs. You can call up Goldman Sachs today and they will verify I worked there until 1986. I have pay stubs left over. The Financial Times, the Wall Street Journal, the CNN, BBC, The Economist, and the New York Times all contacted Andrew Maguire and said, these are explosive charges you've made, and we'd like to write an article about it, but before we do, you have to verify that you in fact worked. Goldman Sachs says they never heard of you. J.P. Morgan says they never heard of you. The people in the bullion market, the Martin Stokes and Kevin Crisps who have traded these metals for decades, all say they've never heard of you, they didn't know you as a Goldman Sachs gold trader or anything else. Can you verify that you were a gold trader at Goldman Sachs or any place else? And in each instance, he has refused to do that. I don't question his existence, I question the fact that he probably never actually worked in the gold market and he's an attention seeker. That's my view on that one. Furthermore, again, I've been in the bullion market all these years. I've worked with major banks, I've worked with major mining companies, I've worked with central banks, and I see that The GATA allegations are full of internal inconsistencies, which simply don't hold up to statistical scrutiny or to simple logic. How much time do I have?
You have about 2.5 minutes. Oh no, I'm sorry, 1.5 minutes. 1.5 minutes.
So, when I listen to GATA, I think they're a gigantic distraction. I realize there are a lot of people who look at the world and they're angry and they don't understand what's going on. I look at the world, I understand what's going on, and I'm angry. I studied money and banking. I've studied banking all my life. I understand how banks go. I've been one of the biggest critics of some of the practices in the banking industry all of my life. In 1984, when I was still at Goldman Sachs, I got a call from a legislative aide. We would like to talk to you about derivatives, and you're Mr. Derivatives, you understand these things, and we're looking to regulate OTC derivatives. So I'm at Goldman Sachs, I got my partner's approval, the partner said, no, don't talk to them. After I left Goldman in 1986, I became an outspoken critic of the lack of regulations of the OTC derivatives market. I have written extensively, and I have consulted with government regulators in Europe, Asia, and the United States about what regulations are required for the OTC derivatives markets. It's never been listened to. I know what's wrong with the banking system, and it's not a gold conspiracy.
20 seconds to go, if you're okay with calling a halt there. I wonder, could I just depart very briefly from the format, Bill, because Jeffrey said Andrew Maguire has failed to prove his credentials. Could you reply to that? Keep it to less than 2 minutes.
Andrew Maguire has been in the gold business for 40 years. He worked for J. Aaron in the 70s, which was taken over by Goldman Sachs. And for you Canadians, he worked in British Columbia for 15 years, at one point owned a gold mine. He's highly regarded by traders in Asia and all over Europe, and he's probably the nicest guy you'll ever want to meet and the least publicity, attention-seeking guy I've ever known. He's just a class act.
Very nice. Jeffrey,
Can I ask you, when did he do work at J. Aaron?
In the 70s.
In London?
I don't know whether it was London or here. I just know he worked for J. Aaron in the 70s.
Because I worked for J. Aaron.
I'm telling you what he did. So
yeah. Okay. I worked for J. Aaron, and there were 100 people in the room. It didn't have a London office, and he wasn't there.
I know he worked for J. Aaron in the 70s. I just mentioned to you that he worked in British Columbia for 15 years and had a gold mine, and that's what he did.
Can we verify it? Can we see some records here?
How about this? You want to bet $5,000 if I'm right?
Oh, I don't. That might be. Okay, I think that might be illegal under Washington state law. Okay, so I think we've gone into that. Now, I'm going to move on because I mean, this is fascinating. Andrew Maguire did make very eye-raising allegations. Bill, I'm going to put a rhetorical question to you, and you have 3 minutes to answer it, and then Jeffrey gets 3 minutes. My rhetorical question is, if this conspiracy is so widespread, why is the gold mining industry not screaming blue murder over it? And I mean, at the top of their voices, they have the resources, they're not going to hold back on something like that, you would assume.
Well, it's a good question, and it's not going to take me 3 minutes. It's pretty simple. First of all, GATA's had the support of over 30 mining companies, including about a decade ago, AngloGold and Goldfields. They gave us substantial contributions. We got substantial contributions from Kirkland Lake Gold, Seabridge Gold, other fine companies. And we're proud of it. But to get right to the point, think about it. You know, when governments are in the gold and gold companies, silver companies, in the mining business, they need to get permits from government. That's the first answer. So they don't want to antagonize governments by going against the system. And two, once they get there, where do they get their financing in many cases? Bullion banks. These are the same bullion banks that where GATA got started in 1999, 2000. These bullion bankers advised the likes of Barrick and AngloGold to hedge. We were screaming about it back then that this was foolish. Can you imagine? There was no profit back then. The bullion banks were trying to make fees and sell a contango and so on. But can you imagine that Exxon hedging at 10? I mean, the CEOs would have been fired. And sure enough, about 2 years ago, AngloGold and Barrick took something like $7, $8, $9, $10 billion in losses, closing out their hedges. And they had the same people back then, especially Barrick, that said GATA was nuts and off their rocker, that this was the right thing to do. It was dead wrong.
Thank you very much. Jeffrey, you have a maximum of 2 minutes to refute.
Let's talk about why the mining companies don't do this.
Exactly.
Well, I don't think it's because they need permits from governments, and I don't think it's because they're dependent on the banks. There are a lot of financial entities that are around that can provide non-bank financing. CIC in China, for example, sovereign wealth funds, private individuals. I don't think it has anything to do with that. I think what it has to do with is the fact that the mining companies have sophisticated, educated executives who can look at the evidence and can say, there's nothing here to support these allegations. I have to focus on running a business and running it profitably and running it efficiently, and this is, again, a giant distraction.
Okay, let's move on now. Do we have a question from the floor, or will I ask another one? Sir, would you stand up and as loud as you can so people up in the peanut gallery can hear you? Thanks. Oh, we have a mic. We have a thing called a microphone. Wow, all mud cons.
What about WikiLeaks type of information? Is anything there really supporting theory?
I'm sorry. Could you repeat the question?
Any information within WikiLeaks that is supporting?
Oh. Well, I mentioned it. All I can say is this is what the cable said from Beijing, the embassy, to the State Department, and it came from, the Chinese government. And it also may have interested you that I've had 3 conference calls with, Jeff mentioned the Chinese Investment Corporation. They want to know what we have to say, as do the Russians. They've spoken about us publicly at an LBMA meeting. One of their top people advisors to President Putin of Russia came to our conference, Gold Rush 21 conference in 2005, and he just came back in 2011 to the one in August and said it was the finest conference he'd ever been to.
And sorry, Bill, could you remind us what was in that WikiLeaks cable?
What it just said that in order to protect the dollar, that they believed that the U.S. and Europe too were suppressing the gold price to help support the dollar in the markets, and it was put in a cable. The embassy felt it was important enough to send it to the State Department, and it came out in a WikiLeaks document, and actually, GATA publicized it, of course.
And the embassy was saying the Chinese had this firm belief.
The Chinese government. Now, this was a cable that was sent in 2009.
Thank you. Jeffrey.
Actually, what the cable said was the Chinese government asked for information related to allegations that they had heard in the market from GATA about that, and what would the U.S. government say in response to those allegations. It didn't say that the Chinese government believed it.
And I think we have a question down there, sir. We'll get you a mic. Oh, I'm sorry, Jeffrey had another remark. I'm sorry, Jeffrey.
I guess I'm running short on these things. That's typical of taking a piece of information and twisting it, and dropping off a couple important words and making it fit your theory as opposed to the reality.
Sir.
I'd like to ask Mr. Christian the question, do you or do you not believe there is a major concentration of manipulation of the silver market going on by J.P. Morgan and HSBC through the futures mechanism?
Thank you. Jeffrey.
No, I don't. I've looked at evidence. If you were here this morning, I showed you some evidence, some data on concentration in the short contracts. J.P. Morgan and HSBC basically are major banks. They make their money by charging small fees on a lot of transactions. I showed some data for those of you who were here this morning. The positions on the futures market that banks have, by and large, are hedges of physical or OTC market transactions, forward purchases, metal that's leased out, and things like that. And if you look at JP Morgan, it actually has record profits in its gold and silver books this year. It earned more in the first quarter of this year in gold and silver than it earned in all of last year. And it wouldn't do that if the price of silver was rising and it had a massive short. What happens is as the price of silver rises, JP Morgan makes its money on fees. You want to buy silver, 25 cents an ounce. You want to sell silver, 25 cents an ounce. You want to borrow silver, 3%. A year ago, the price of silver was $17, and they were making 50 cents an ounce per year by leasing silver at 3%. Now, in the third quarter, the price was $39, and they were making $1.17 per ounce per year by leasing the same metal at 3%. That's how JP Morgan makes its bank. Additionally, if you go, and again, you can go to our website, or you can go to cftc.gov, and you can download studies, very detailed studies that the economists at the CFTC did in 2004 and 2008. And they said there is not undue concentration. These are primarily hedged positions. And in fact, if you do look at it and you see that top 4 banks have a certain concentration of the short position on COMEX, the CFTC has the disaggregated data, and they can say, oh, interestingly enough, the top 4 banks change names. So it's not JP Morgan week after week, nor is it HSBC week after week. Now that said, the bullion banking business, like all other banking business, is increasingly concentrated in a handful of banks. Not because those banks have squeezed out their competitors, but because other companies have said, there's not enough money in bullion banking for me to support a market-making operation. If you look at the London market, for example...
Might have to cut you off in a sec, Jeff. Okay. Bill, please.
I don't think no matter what GATA says, no matter what it is, Jeff will agree with. So what I'd like to do, because a lot of people here on what's going to happen, how are you going to make money, where are we going to go from here? 2 years ago, Jeff jumped up and said that the price was of gold was less than 1,000. He said the price was going to average $946 for the next decade. Recently on BNN, he came out and said on the dip, he said that the price of gold was going to average $1,200 to $1,300.
Bill, I'm very sorry to interrupt you. I know it's bad form, but I thought we were going to do the outlook thing at the end.
Okay.
I'm very sorry about that. I wonder, would you mind addressing, would you like to refute what Jeff had to say about JP Morgan and HSBC? Again, I'm sorry for interrupting.
Well, I mean, in terms of JP Morgan, at the time of our hearing, there was 30,000 contracts short. The concentration is ridiculous. In terms of making money, yeah, they make a lot of money. When the price is at 48, 49, they bomb the market in Hong Kong when there's nobody around at 2 or 3 a.m., hit it with thousands of contracts, the thing goes down. Their buddies at the CME raise the market because they want decreased volatility. Volatility goes through the roof. Silver goes from 50 to 30. The specs covered, they get out, and they make 15 to 20 bucks. You do that over the years, this and that. Yeah, that's why they made a lot of money. That's how they do it.
Thanks, Bill. As I say, and actually the suggestion came from one of our debaters, at the end I'm going to give each guy 3 minutes to give his outlook for the next year, and I think it's a nice way to cap off the debate. Do we have another question from the floor?
Actually, Andrew, we have a question from one of our KICO viewers.
Oh yes, on the internet. Thanks, Danielle.
Yeah, it was about CME margin hikes, and they were wondering, well, they say CME says the reason they do margin hike requirements is to manage the volatility in the markets. But they're wondering, is this not a form of manipulation? Why does it always seem that these margin hikes happen when gold is rallying?
That's an interesting question. The question is, why do the exchanges, or in this case the CME, only seem to hike margin requirements when the price of silver or gold is going up? Bill, would you take that first?
Actually, Danielle, it's the opposite. They raise the margin after the bad guys, as we would call them, the gold cartel hits it. And all of a sudden, you know, it goes down $20,000, $30,000 a contract in a day, 40,000 contracts. If you're not ready for it, and people aren't, they get spooked out. And actually, a better question might be right now, the volatility in silver is way down from when the market was going like this. Why haven't they lowered the margin requirements? Why not? Because they're scared to death of a squeeze coming, and they know it, and that's what's going to happen.
Jeffrey, would you talk about the CME's decision to raise margin requirements? Do they in fact do it at times when precious metals are rising?
They do it when prices are rising and when prices are falling. Whenever there's a requirement to top off the clearinghouse so that you can protect yourself from default. Actually, it's interesting because people criticize them raising margins when the prices are rising. But when the prices are rising, if you're long, you're building value as the price rises, and a margin increase is not bad for you because it's not negative for you because you have more value in your position. What happens, and what happened, for example, in late April and early May, was that as the price of silver was rising, those companies that were short have an exposure, they have insufficient margin, and you raise the margin requirements to meet that. So increasing margins in a rising price is actually harder on the shorts unless they have physical silver against those positions. So if you look at the margin requirements as they were raising them there, you find that, you know, if you're at JP Morgan and you have a physical collateral against that short position, you don't have to increase your margin balance because you've got the collateral. But if you are a naked short, then you have to raise it. So, you know, there's a great deal of misunderstanding. Now, the reason why they raise the margins is to make sure that the clearinghouse has enough money to cover defaults. When silver is $20 and someone buys a contract, they have exposure to $20 silver. When it goes to $40, they have 100 times more exposure. So the exchange says you got to pony up more money to cover your short position. And there's never been a default of a major exchange or clearinghouse in the United States, expressly because the exchanges require people to prove that they have the financial wherewithal to cover their positions.
Let's leave it there. Another question from the floor? Or Daniela? Oh, no? Okay.
Okay, I seem to remember some years ago when Blanchard and Company, I think, took a case against the
Barrick
gold companies,
yeah,
with regard to their hedging position. And the world's greatest producer, I think, is Barrick Gold, and they were allowed to opt out from that lawsuit on the basis that they were agents of the U.S. government.
Okay, well, this has come up. Bill, would you talk to that first, please?
Well, it's complicated, but it's a really interesting story because Blanchard sued Barrick for manipulation of the gold market. And Peter Monk, their chairman, this is all public information, was in London giving a big speech extolling hedging. This was fantastic, great tool, should be done. The very next day, all of a sudden, his CEO, Greg Wilkins, was supposed to speak and canceled his speech, flew to New Orleans, and Peter Monk said, we're not hedging anymore, overnight. And it made all the press was in it, New York Times. What the heck's going on? They thought the guy had gone mad. And the point is, the Blanchard lawsuit did have that effect, and whenever they came to some agreement and why the lawsuit didn't go further, that's not to be heard yet. But yes, the judge was talking about, Barrick was claiming that you can't sue us because of central banks and sovereign immunity, and they're too big. The judge really dismissed it in that case and let the court case go on, and then it was settled.
So, Jeffrey, as you know, GATA has made the case. Well, Barrick were claiming that, they say that Barrick claimed we're operating in concert with government.
This is a perfect example of what we're here, because actually what happened was Blanchard did sue Barrick and JP Morgan. All three companies were our clients at the time. And in fact, we were providing information to Blanchard. We said, don't go there because there's no thing there. And what you said, you heard from GATA because they... No, let me explain. Here's what actually happened in the court. Barrick said that central banks were being sued as part of this, and central banks were immune to from Blanchard's claims because the foreign central banks can't be sued in the United States courts because of sovereign immunity. And they said if that's the case, and if central banks are involved in this thing, there's a law that says that if you can't sue everybody involved in a conspiracy, you can't sue anyone. That was the claim that Barrick made, and I have the legal document, and I can show it to you. What happened was GATA wrote, and I quote, Barrick Gold's claim made in district court in New Orleans in February 2003 to share the sovereign immunity of central banks against lawsuit, insofar as Barrick was their agent in shorting gold to help control its price. That's not what Barrick said at all. It's not what Barrick said at all.
We'll have to cut it off there. Guys, we're almost out of time. It's been a wonderful experience. I'm going to give you each 3 minutes to give your outlook for the gold market over the next year. Bill, would you mind starting?
Yes, but real quick, I couldn't resist. Jeff, were you advising Barrick the hedge when they thought it's the $8 billion loss that they took a couple years ago? I'll leave it at that.
Let me just say this. Every $1 billion loss that Barrick had on its hedge book was offset by $6 billion increase in its balance sheets because the increased gold price raised the value of their reserves and resources.
All right, you can answer that on your time. Let me just finish here. Second of all, honest to God, have you looked this up? All this thing about raising margins when the price is going up is not true. It's after they hit it every single time. I ask any of you here to check this out and then put it up in the internet. Anyway, real quick. Last year, the price was $23. And from my comments last year, I said all kind of things going to happen with JP Morgan, shortages and so on, that the price would probably go to $30, $40 in 6 months. Those of you here listen to me, that's what you heard. So what do we think now? So we come back next year and stop this he said, she said, who's right, who's wrong? Because we think, as you heard Eric Sprott, we're working with the right numbers. We think they're working with the wrong numbers. We disagree. So here we go from here. I think the price next year will double from here, go to 60. You're going to hear more about shortages. and more about Morgan's role in the short position is going to come out. So let's come back here from a year. We'll both stand up here again and see who's right and who didn't get it.
Bill, do you have a target for gold? Where do you think gold will be in a year?
Gold can do it. I mean, same silver I think is more explosive because, like you said, Eric and I and some others that think that BICs and people that there's a real problem. And right now, for example, there's all kinds of reports about shortages. And from what we know, it's the dealers are really concerned not about the price so much as getting delays because they don't use that much in a product. So they're really petrified of word getting out that and the price going up. But as far as gold goes, I don't know. I think you'll probably see 2,300.
23. I know a lot of people in this room will be happy if that happens. Jeffrey, can we get some kind of a guideline, a prediction for silver and gold over the next year?
I'll be a little bit closer in first. We think that gold and silver prices are going to be extremely volatile in the next 3 months. There are things going on in November and December that we think could cause the prices to whip around quite sharply. Over the next 3 months, we think the gold price could fall as low as $1,500, maybe even a little lower, $1,480, $1,530, so let's say $1,500. And we also think it could rise to $2,000 or $2,100. There's an enormous amount of options that have been sold to institutional investors for December expiry with $2,000, $2,100, $2,500, $3,000 prices, and delta hedging of those options if the price starts rising could drive the price up. Over the next year, we think the price is probably going to continue to trade in the, say, $1,500 to $2,000 or $1,500 to $1,900 range. A lot will depend on what happens with European and American politics, and I don't want to call the U.S. election. So if things go badly, we could be closer to 2,000, and if things go well, which I can't imagine, given the slate of candidates, it could be close to 1,500. In terms of silver, again, we think the range in the next few months could be $26 to $42, and we think that over the course of the next year, quarterly average prices will be like $30, $33, about where they are now. And the range could be, again, like $26, $25 on the low end, and maybe $38 on the high end.
Gentlemen, thank you so much. Could we have a big hand for our debaters?
Well, that wraps up our great silver debate coverage. We hope you enjoyed it. And please send me your feedback. I'm sure you have lots of it, and I want to hear from you. So email me at newsfeedback@kitco.com. For Kitco News, I'm Daniela Cambonin.